Thank you for inviting me and putting this together, Nancy.
You're very kind. Thank you. So my name is Nancy Fulton, and I run a variety of events designed to help people start and run stronger businesses. And I run events for filmmakers, and I also run them for creative entrepreneurs, including people that create apps and people that create various kinds of media and distribution solutions, as well as brick and mortar businesses ranging from restaurants to dry cleaners and so forth. I asked Michael Praver to speak with us today because he's got more than a decade worth of experience helping startups and small businesses launch and grow swiftly. And I think what I'd like to do is ask Michael to talk for a few minutes about his background and how he acquired the skills that he uses to help people grow their businesses, and specifically maybe talk for just a few seconds about the industries in which he's worked and the kind of people that he's helped in the past.
I came from a background of commercial real estate. That led me more to the finance side of commercial real estate than the physical part of commercial real estate. Eventually, I moved into owning a very large portfolio of residential mortgages. I essentially bought broken mortgages from the banks and helped people out of those situations, be it through refinance, through helping them sell their house and doing a short sale, because I essentially was the bank at that point. It was really, I want to say, a need to feel like I could make money and serve people at the same time. And that's why I had such a terrific time in a mortgage portfolio that I owned. Of course, that all kind of crumbled when the market crashed, and the value of those properties. At the time, I had 294 mortgages personally. So at the end of that, I started a company with a friend doing equipment financing. But during the 6 months or so that we were trying to start that company, I was getting calls left and right for startup companies. A lot of gourmet food trucks, but every type of startup company you could imagine. And I asked all of the smartest people that I knew at the time how we can fund a startup business. And their answer was absolute, that it cannot be done. It wasn't difficult, don't try it. It cannot be done. And I kind of love that because, I didn't tell anybody, but I spent the next 6 months trying to figure out how to do it. Literally the day that I figured out how to start a startup business, and I include any business that is obviously a startup, but also any business that wants to start up in an industry that the banks don't serve. So gourmet food trucks are basically a big box that you have a kitchen inside of and light a fire inside of. It's not something that any bank will do. There's no list that says we don't do gourmet food trucks, but clearly they would never do one. And so it's very funny, the very first business I went after when I figured out how to do this is the gourmet food truck companies. And I called all, I think it was 48, 49 in the country as soon as I figured out how to do this. And most of them thought I was crazy, and one or two gave me the opportunity, and I started funding them. And as soon as I started funding a few of them, all the others kind of caught on. So that's the origin, Nancy, of how I got into this business. Mm-hmm. And I've been doing it for 10 years, really film only for a year. Mm-hmm. But film is nothing but a startup business, and a business that no bank will touch.
Right. So, and I think that's one of the things I just want to, so your background is basically in by way of sort of traditional business finance for real estate and for traditional, for lack of a better term, more traditional businesses. And then you specifically decided to move into startup and business, startup finance, which includes film considers film a startup, which I think makes total sense because it is a startup. It's just a startup that produces film.
Everything we do, all of our consulting, mm-hmm. is geared towards growing your company. That's really where we fit in.
Right.
So yes, we do startup, but everyone knows us as mm-hmm. a company that does startup.
Mm-hmm.
But all of our guidance is, what's the next step? Where are you trying to get to?
Mm-hmm.
Here's 2 or 3 options. Which one are you planning on doing in the future? Let's
Right.
move towards that.
Michael's not actually here to sell anything particularly, and the products that he talks about aren't products that he sells. He's talking about products and solutions that the banks offer. So the information will be information that you can apply, you can start applying right away. So I think what we should start doing right now is, if it's okay with you, we should go ahead and start working through the slide deck. Does that
Please.
make sense? All right, cool.
Great.
So what you need to know about business finance, and now we're going to go to the first screen.
Most companies that I deal with are startup, meaning that they're less than 2 years old and they don't have a large revenue stream, and or they're in a business that is not acceptable to the lending community, like we're going back to a gourmet food truck that you light on fire on the inside, or an intellectual property kind of business like a film. Tech startups, new brick and mortar business, media producers, these are just examples of any business that can be considered a startup. And again, startup means anything under 2 years old or anything that doesn't have real revenue.
Right.
And I hate to say it, but if you have a 2-year-old company that has real revenue but doesn't have what we might call full documentation, we're talking about up to the minute tax returns for the owner and for the business and every other applicable document, again, we consider you startup.
Right. Also, you have this link here that says anyone seeking investment. One of the things when you and I were first talking a while back, you said that a lot of times business owners start going out for investment. They go sort of too soon, or they go out without realizing that investors really care a huge amount about what kind of finance resources a company has, because it will determine how likely the company is to survive.
So yes, I meet a lot of people in the Santa Monica kind of startup community that are looking for angel investors or first round funding so soon that basically they're just in the point that they're naming their company and they're already looking for investors. Well, I understand that, and investors are fine, but investors are equity and we arrange debt. Equity and debt are clearly not the same thing. Debt is not giving up any ownership of your company. Now, in the startup community, in the high-tech startup community, I've seen people offering 50% of their company for $50,000.
Mm-hmm.
And I find that incredible, because unless the company has a 1 in 1,000 chance of succeeding, they're just doing it too early. The further they push out those discussions with equity investors, I don't care if you want to call it an angel investor or a round one or actually an A round, it doesn't matter. The earlier you work with equity, meaning giving up a portion of your company, the more of your company ultimately you're going to give up. Because if you're pre-revenue, that means you really don't have a working model or a working model for income, then you don't have much to show. And so you're, to an investor, your company's worth very little. So the earlier you bring on debt, the further you can push out those investment conversations, the better off you will be. As you grow your company, you are going to have flexibility. If you have a line of credit, you don't have to necessarily use it, but it's there for you. So it gives you flexibility.
Mm-hmm.
You only pay for what you're actually using.
Mm-hmm.
And as you grow your company and you grow your personal and business credibility, you ultimately, and I guess this is sort of obvious, you will pay less for that money. So if you're not graduating from personal credit to business credit to SBA, then you're staying with the more expensive products versus the lesser expensive. SBA right now is running around 6.25%. I know that that will change over time,
Mm-hmm.
but at 6.25%, that's some very aggressive kind of rates that the banks/government is offering.
When you take $250,000 from an investor, theoretically, you're going to give the investor his money back plus a profit, or you're going to take his money that you take the money that you earn that you would give back to him and reinvest it. So
That's correct. It's the least flexible thing I could imagine, because what are you going to do? You're going to take $250,000 and you're going to put it in the bank, and maybe you need $10,000 or $20,000 immediately, and the rest is sitting there. So you're paying for the money that's now sitting in the bank, earning, 0.5% interest, 1% interest, because it's going to be there a short period of time. A line of credit can be used over and over and over again.
Mm-hmm.
You only use, you only pay for exactly what you're using. And a lot of times, when we're talking about business lines of credit, we're looking at a free period, an incentive period.
Mm-hmm.
That incentive period is often 6 to 12 months for business lines of credit and 12 to 24 months with personal lines of credit.
You're paying 0% for a limited time, which gives you time to be able to make the transition to getting credit on better terms.
That is correct. You're building your business and personal credibility.
Mm-hmm.
So we could spring off of that. If we get you 100,000 next year, it'll probably be 2, and the next year 4. But if you don't start, we can't springboard off of that previous number.
Right.
And then, of course, we're moving from a financial product like personal credit to business credit to corporate. So we're moving to the more sophisticated and consequently less expensive financial products. Yes.
Cool. So do you want to
Okay.
move? Shall we move on to the next
Please.
one? Cool.
Thanks.
Hold on. Great. All right. So business finance and investors. To get an equity investment, you mentioned that when you get equity investment, you're always going to set up an LLC or a C Corp, et cetera. And what you're doing is selling percentages of that business. And you mentioned that the reason to do the finance is to make it so that you can use credit or relatively cheap money to get the corporate structure, create the minimum viable product, get the proof of concept out the door, working business model, and you end up creating a package that investors want to put money in on much better terms, and that allows you to get money more quickly, often as well. So that's one of the reasons why if you want to get investors, you really need to have a solid understanding of business finance options. Is that I think
yes.
Is that correct?
Yes. No investor is going to invest in something that's not an LLC, a C Corp, or an S Corp to begin with.
Mm-hmm.
When we're doing business finance, you need to open up an entity for us to do business finance, not personal finance, mm-hmm. and not personal finance that you're going to lend yourself money for your business. But if we're doing business finance, then mm-hmm. we need a business to do it with. Absolutely.
Mm-hmm. And it has to be of a certain age before a lot of options will be made available to you, like two years or something like that as a rule.
Yeah, we're going to do another talk in the future about all of the aspects, such as what type of accounting, what type of bookkeeping, what documentation you're going to need in the future to be considered a full doc loan. Mm-hmm. Because if you expect to really, have access to all of those kind of products after 2 years, you're going to have to show documentation. You're going to have to do it right from day one. So mm-hmm. we'll put together another talk in the future about what all those steps are, and I'll even recommend some companies if anybody's interested.
All right, cool.
But yes, you do need to open up an LLC for us to do business finance, or it's still considered personal. When a business is young, under 2 years old, or less than, sometimes it's up to 500 employees, mm-hmm. and or does not have revenue, then many banks will call that a startup, even if it's 10 years old. It's still mm-hmm. a startup to the bank. Mm-hmm. And many people think when we're doing business finance in the startup vein, in the under 2 years old kind of companies, that the business finance is not personally guaranteed. And so I want to dispel that right now.
Since 2007, 2008, any
Very
credit that
long
you
time,
get
yes.
is going to be personally guaranteed.
That is correct. Now, there are some variations if you are leasing equipment, but don't forget, equipment is guaranteed by the piece of equipment. So it's what they call secured.
You wanted to review with people how to make it so that when they're building their personal credit, that they're going to be using for business purposes in the first 2 years.
Sure, let's do these one at a time if you don't mind.
Cool, go ahead.
Okay. When you want to get more revolving credit, make sure your utilization is less than 30%. So we're not saying that you need to stay at 30% because that's very little money. You have access to all of your money, but you don't want to ever necessarily max out your credit. There's a threshold that each person is comfortable with. Don't forget, the more you use personal credit, the lower your credit score, not long term, but at least at that moment. And you're going to scare the banks.
If somebody has like $50,000 and they're using $10,000 or $20,000 of it, the bank that's kind of going to be pretty reasonable. But if the bank sees them shooting up to using $40K, then all of a sudden they're not going to look nearly as attractive.
Not only that, but you have to balance off of your personal credit. You don't have to do this so much on business credit, but on personal credit, it's not only that you're using 40 out of 50, which of course is a little, you're starting to push the edge there, but it's the balance of each card. In other words, you would not, let's say you were only using 20,000 out of your 50, but if you were using 90% on one card, they're not looking at anything else. They're looking at that highest percentage. I'm not saying 80% is necessarily a problem, but when you go over 80 and especially over 90, you have to do that in a very limited way. You can't do it very often, and you're really at risk for the lenders to go back in and reevaluate you, and they have the right to lower your limit. And that's really what you want to avoid. They're going to evaluate you on how you behave in the first 12 months. So if you're late once or more in the first 12 months, and one day after that 12th month, you want us to go back and renegotiate, you sort of cut our legs out because they have decided that you are not the client that they want to lower interest on and increase the limits on. Does that make sense?
Yeah, it does.
And one of the easiest ways to make sure you don't screw up is to literally open up a savings account and have your personal or business lines of credit withdraw the minimum payment from that savings account.
In the ballpark of 2 years, you're going to be transitioning from personal credit to business credit. And can you sort of talk about, you said before, it's still personally secured, but there is a difference in how business credit reports to the banks and so forth. So can you sort of explain how that works?
Sure. Okay. The type of business lines of credit that we can do from day one, a startup company, we have approximately 6 lenders that we can use. And we can put together what we call business lines of credit or true business lines of credit that do not show up on your personal credit at all. So remember when we talked about not getting past 60, 70, 80% and making sure that you balance out all of the accounts? Well, if we do true business credit, Nancy, there's no need to balance out accounts because you could go to 100% or 99% on the line of credit, and the lenders don't really care because it's business lines of credit. They see you're investing in your business. And also, it doesn't show up on your personal credit.
I think you were just telling me a story about somebody you just refinanced who he had a production company, and it was a pretty successful production company, but he had personal lines of credit that he was using to, when they bootstrap a project.
Well, but it's not an uncommon story. The guy owned a production company. He's a multi-millionaire, but he didn't have money available, and he
Mhm.
needed $40 or $50,000 for a particular campaign they were doing. I think it was some sort of advertising campaign.
Mhm.
Um, and that's how he got to me in the first place. But after talking to him for a while, it turned out his real issue was that he was still running his company on his personal credit after 8 years. Now, obviously, if we had talked to him earlier, by the second year, or even on the first day of the opening of the company, he would have been at a business credit, not personal. So we raised him about 130,000. I don't remember exactly, in business lines of credit,
Mhm.
and he basically pulled his personal lines of credit from his CFO and said, "From now on, use these." As you've alluded to a few times, when you become 2 years old or older and you're a real company,
Mhm.
assuming you can do what we call a full doc loan, that means not unsecured, no doc, but tax returns, corporate tax returns, all of that good stuff, then you have many more options. And we want our clients to have as many options as possible. So, do you wait till you're 2 years old to start thinking about those things? No, because a lender wants to see 2 years tax returns, personal, 2 years tax returns, business.
Mhm.
They want to see, you know, um, your bank statements. They want to make sure you're not commingling. There's so many things that, again, we don't want to talk about it on this call, but if we don't lay those things out, then the clients won't know what to do.
Okay, so and I
What do
think
you
one of the things that you
think?
talked about is that you should, when you first start your business, you should set it up in a corporate structure like an LLC, like an S corp, like a C corp, et cetera, that has a, federal employment identification number. And
Right.
you should. So even though the stuff, if you're starting it with your personal credit, it's going to be using your social security number for that credit. You should start. You should get something. You should establish your company not as a sole proprietorship, but as using one of these corporate structures. And you should make sure that you have a federal employment identification number so that you can actually show 2 years of history
That's
on that.
correct. Yes. What you want to do is, we have people that come to us all the time and say, well, I have a structure, but it's, sole proprietor. Well, yes, we can do business credit on a sole proprietorship, but I'm just telling you, and I'm not your accountant and I'm not your attorney, but there's just no question you're going to become one of those structures. So if we raise money in a business line of credit for your sole proprietorship, knowing that within months you're going to bump up to an LLC, then we have to start all over again. It doesn't make any sense. So even though we can do it, we strongly, I mean, I've done a couple of them, but we absolutely strongly recommend becoming the structure that you're going to end up. So if you're going to end up an LLC, become an LLC the day before we do the business credit, not after.
Just to make sure everybody knows, if you have a business and you want to take money from angel investors or from investors, you can't just take your business plan around and ask them to write you checks. That's illegal. It is on a scale of 1 to 10. It's like 400% illegal. You actually have to do, in most cases, you're going to do a Regulation D private placement, or you might use other solutions like convertible debt or whatever. But in any case, you are going to need to have a corporate structure.
Sure, but that's just one more reason that you need to go to an LLC, an S corp, or a C corp.
Mm-hmm.
Absolutely.
Exactly. Or I think there's also limited liability partnerships and so forth. Can you sort of review what the
Sure.
heck a Dun & Bradstreet is?
Sure. Okay. So everyone knows what a personal credit report is and what it looks like, and there's a score that is to you personally. Well, a Dun & Bradstreet, a Equifax Business, a Paydex score, these are all different scoring models for your company. So your company has a credit score just like your person does.
Mm-hmm.
Okay, so when you're talking about especially things like equipment leasing, the first thing they're going to do is look up your Dun & Bradstreet or your Paydex score. And yes, Paydex is actually owned now by Dun & Bradstreet, but there are two different scoring models still. And so you want to build it up as soon as possible and as high as possible in case you need it. So if you want to, in particular, it comes in when you're doing heavy equipment. When I started that company 10 and a half years ago, or started to, during the worst economic times, it was all about a Paydex score or a Dun & Bradstreet score. Now, they also did looked at your personal credit too. Personal credit was absolutely part of it, but if you didn't have a Paydex score, there was no reason to even, submit an application. So is that clear? Did you want more, or is that?
No, I think
enough?
I think that's cool. I think it's just okay. Understanding that it's a company that basically creates credit reports. You intentionally build your Dun & Bradstreet credit profile by, part of it is ensuring that they get the reports,
Yes,
and all those kinds of things. So you intentionally build it.
You have to be very active with it. That's correct, Nancy. You, if you don't have a score, a number theoretically, eventually they're going to call you up and ask you some questions, and a year or two later you might get a number. But if you really are on top of your business, you may want to call them up, ask them for a number. You may actually want to join. They have different levels from $200 to $900 a year where you can actually pay a fee and instantly get a number, and they allow you to put in a lot of information yourself, not just found information on the internet, but put it in yourself. And then when you acquire business lines of credit, you connect them to your Dun & Bradstreet. So if you let it happen on its own, it doesn't always happen, and it can happen very slowly. If you have a very established credit report, it's like having a very established business credit report. So you're going to get better terms and more money and pay less for it. Yes.
Right. So now let's talk about the very special and unique environment of equipment financing. Let's say that you want to set up a dry cleaning company, a dry cleaning service. If you decide you're going to go get, a loan, well, you want to make sure that you're getting the equipment lease is handling the money is paying for the equipment that you're actually use for the dry cleaning, because otherwise you're going to be paying way too much to get that hardware.
You don't want to use your unsecured. Is that where you're going? You don't want to use your unsecured lines of credit. Since your unsecured lines of credit can be used for any purpose under the sun, you don't want to use them, if you could avoid it, for heavy equipment or even light equipment if there are equipment financing companies out there. Now, even though you're building up a Dun & Bradstreet, and a Dun & Bradstreet often is used for the equipment financing side of this world, very often the rates that you can get on equipment lease are really from a manufacturer. That's why, 9 out of 10 Toyotas that are purchased using Toyota Finance, because Toyota Finance has an incentive to get those Toyotas out on the road. So they're always going to be the least expensive option for financing. Same thing here. I had someone, I don't remember how many months ago it was, but who was looking at very expensive, high definition cameras for a production company. And they were all excited about the prospect of signing a lease. And then I brought them to Sony, and I think it was Sony and Canon. And even though they were now looking at new equipment, they couldn't do it on used equipment. The new equipment, all the bells and whistles, was going to cost them the same as the used equipment they were looking at, because the financing was so aggressive.
I think like most people, I started my first business when I was 20 or so, and I kept looking at SBA loans, and I kept thinking, it seems like these people want to give me money, but it never really seems like it works out that way. And it really wasn't until I met Michael that I sort of, and until I started talking about SBA loans and how to correctly use them, that I realized that, one, what I had been thinking about doing with them was stupid. And two, that that just because a bank says it can do an SBA loan doesn't mean it's actually going to do it. So, and I also want to make sure that everybody listening, if you're a startup, you may be thinking, well, I can't qualify for an SBA loan instantly. Yes, you can. Absolutely. So if you're just starting a business, pay very close attention, because this is a way to start your company in the black. So, and Michael's going to go ahead and sort of walk through it, but I want to make sure that you understand. If you right now don't have a business and you want to make it so, and you want to start a new business, one of the smartest things you can do is actually go buy a business using an SBA loan, which doesn't require insanely great credit or a lot of cash up front or anything like that. You can, and then take your startup and take what you were going to do in your startup and incorporate it into that business to make it more profitable. So in effect, you can do what you were going to do with your startup by grafting it on to an existing business and making that existing business more successful. So I just wanted to give that introduction so the people that are startup people realize that this is actually 150% something they should be paying attention to. So Michael, do you want to go ahead and walk through what people can use SBA loans for?
Sure. This is a partial list right here, but purchase an existing business of almost any kind. Now, as Nancy was just talking about, what that means is that you're not really having to prove anything. The business will either qualify because it is already fundable, meaning that it is profitable enough, or it won't. It's nothing that you're doing to make that happen. It is purely the fact that you're buying an existing business that meets the SBA qualifications. The qualifications are very stringent. They do a ton of research. And so if you're buying a business that has the income to support the purchase, then you are automatically going to be in the black from the day that you purchase that business. Purchase a property or the resources to expand a business. Okay, so if you own let's talk about that donut shop I mentioned earlier. They have 3 gourmet food trucks and 1 physical location, but they're using the SBA loan, even though they're using the money for 4 different purposes in one loan. They're purchasing a second location. That's a very expensive thing to build out. They're not buying the building, but they're doing a very expensive upfit. They're looking at spending $450,000 on opening this donut shop location. And that's just on the inside of a building that they don't own.
Right, and if they wanted to, they could also purchase. You just told me about the furniture company that's up north, and they were renting for $17,000 a month or something ridiculous, renting where they worked, and the renting.
No, they were renting for $27,000 a month.
Right, and which included their workshop or production facilities, and then their big showroom. And you
separate, yes, and they had to drive back and forth every day, all day. They were driving back and forth,
right, and you
between the two locations.
And you just basically asked them, why don't you just want to go ahead and own something? Because you're paying enough to buy something. And they well, that's what they go ahead.
That's what they did in the end, is that they took their 2 locations that they were renting. One is showroom, one is warehouse. They consolidated them into a single building that faced a road, so the front of the building could be showroom and the back of the building could be warehouse. So they consolidated. Their real estate is worth twice as much. They were about to save a huge amount of money, and they actually kind of overbought the building. So they went and bought a much bigger space than they would have.
But they actually own the building. They actually own the building and the land under it. They actually own the SBA is actually purchasing for these people a physical land and a building.
It's not just land and a building. Land and a building, and there are 3 partners in that transaction. Mm-hmm. And we're talking about almost $2 million worth of the sign on front of the building, the upfit, the shelving, the what do you call those? the forklifts, everything that's going inside that building, other than the the actual bathtubs and showers, and those are the kind of things that they sell,
Mm-hmm.
is being done by the SBA. And we did it in 2 loans. We've already closed the building for about $2.2 million. The tenant, or the future tenant themselves, the owner of the building now, they are still deciding how much they want to spend. So in other words, we did a 2 close. The first was for the building. The second one, which will be somewhere between $1 and $2 million, will be for how that building is going to be
Outfitted.
Improved, outfitted, literally the shelving and the lighting and the big pylon sign in front of the building, which sometimes costs over $100,000 for that big sign,
Mm-hmm.
is all being put into the second loan. And when I say second, they will, in other words, they
Another
literally
loan.
are going to do payments. Yes.
Right.
But it's no different than if they had done it at one time. The problem with them is that they weren't really ready. The seller of the building had agreed to sell the building on a certain day, and he was being very tough, basically threatening that he was going to sell it to somebody else. And so the SBA stepped in and said, let's separate the loans, let's close on the building, then we'll close on the business.
Cool. Well, and
even though they already own the business, they're closing on the improvement to their business.
Yeah, so they're just doing 2 operations. It'll be 2 SBA loans, but it's happening one after the other. And then the other.
But for one business, yes.
Right, and then you're talking about, and then you mentioned that you can actually use it to purchase a franchise as well.
Yeah, franchises is terrific. It's actually, our minimum is $1 million SBA loan.
Mm-hmm.
The SBA will do a smaller loan, but we'll go down to maybe $600,000 if you're doing a franchise. The reason is that if there's a $5 million cap, almost everyone who buys a franchise will eventually buy a second and a third and a fourth and a fifth. So we're willing to go lower on a franchise.
Mm-hmm.
Franchises are actually very simple and straightforward with the SBA because they have, again, all the statistics in the world. Subway is a bad example, but it's the first thing that came to mind. If they've done 1,000 Subway restaurants, they know everything about what will and won't work. They can look at a Subway restaurant, the SBA, and instantly tell you if the numbers work. So it's actually not as complicated as you might think when it comes to franchise, because it's absolutely Domino's Pizza, cookie cutter, exactly the same every time.
Right, and they already know all the numbers, and everybody, and the SBA has already agreed. Already knows that they make money, so it's just a very straightforward gig. So let's just take.
Yes, but they also know in reverse. They instantly will tell you that franchise is not doing so well. There's a positive and negative rating. I mean, so it's not just positive. They will also tell you, oh, that franchise doesn't work and that one does.
Yeah. So
if you're looking at 2 different franchises,
they'll actually tell you
you can instantly.
Yeah.
Yes.
They'll actually tell you can't have that business. It's not going to work. We're not funding it because we know.
Well, they also can say it's a highly suspect one. If one is 100% positive and one is 7% negative, do you really want to try and climb up that rope, or do you want to just go with the one that's 100% positive and you can close them that way? Right.
So you mentioned that when if somebody just buys a business, which is just to say a business that's renting a location. Like let's say I want to buy a donut shop, but the donut shop doesn't own the location that it's at, but does good business. I can use an SBA loan to buy that donut shop, and I have up to 10 years to repay that loan. But if the donut shop owned the little storefront that it was in, actually owned the property in the storefront, I could take up to 25 years to repay the loan. So once people are buying real estate, it makes it so that they can have a much longer term for the loan. Is that correct?
That is correct. It's an amortization. In other words, if you make your even payments every single month, After 10 years, you're paid off if you're buying a business only.
Mm-hmm.
But if you're buying a business and building, but as long as the building is at least 51% of the purchase, there's a 51% rule.
Mm-hmm.
If you're buying $1 million pizza parlor,
Mm-hmm.
and you negotiate to buy the building, and the building is $1,100,000, now it's a $2.1 million deal, as long as the building value is a little bit more than the business. They call the whole thing a real estate loan.
Cool.
So you go from 10-year loan to 25-year. But think about, Nancy, how that's kind of obvious if you think about it a different way. You were the SBA putting on a loan guarantee on top of a bank,
Mm-hmm.
but you're buying a business. A business is not very tangible. Now all of a sudden it's a real estate loan. Well, there's ground underneath it. There's a building that exists. No matter what happens to that business, that building is still there. Do you understand why
Yeah,
to
so
them
it's
it's
secured,
much
so they
safer
might take
loan?
the risk for longer because they're sitting there going, well, you're not going to, blast this little property out into the outer space. So no matter what happens,
Right.
if your company goes out of business, we still have the land and we know what the land value is.
Not only that, but statistically, the land value and building value are going up every year.
Mm-hmm.
So they have an appreciating asset.
Mm-hmm.
So yes, if you were the SBA, you would see it differently.
Right.
And that's why they're willing to make. You realize they're talking about somebody who comes to us and says, "I want to buy a $400,000 pizza parlor," and we say, "Well, that's too small." And they say, "Oh, is it in its own building? Great, go talk to the landlord." And all of a sudden, it's a $1.2 million deal.
And
that
it's easier to do. Everybody's happier because it's more.
Everyone's happier because it's more, because it's enough for us to do, because our minimum's $1 million. It's a safer loan for the bank and the SBA, so it's better on all levels.
Right.
Yes.
So now the other thing you mentioned is, let's say you're just a normal person wandering around the street thinking you've wanted to start a business for a while, and your personal credit score is like 650. You can actually just go and look around for businesses that are in the industry that you want to buy, and you can actually just go get an SBA loan to actually buy that business. So your personal credit score, it can't be really super low unless you've got, but it's 650 is not incredible. It's not very high at all. Because what matters is what the business's value is, not your value. It's like it's not. It's the business is the thing that matters, and the business is something that generates revenue. So they're going to look at the business to see if it's generating revenue, and then
the credibility for the deal is really coming in by the business you're buying, and not from the buyer. The buyer is 20% of the decision, or 15%, not the substantial part. The substantial part is, does the business make sense, and does the business warrant the SBA loan?
Right.
Not you.
So let me go ahead and let's go ahead and go to the next slide, and let's see, because we have some examples that make it clear. And with your permission, I'll sort of read through the example. So the first example is a startup business founder, Fred White, wants to found a business that publishes apps for businesses. He uses an SBA loan to purchase an advertising agency for $1.2 million, which has revenues of $40K from 350 active customers. $40K a month, I mean. He pays 6% interest in his SBA loan. He's going to pay 6% interest, so his payments are going to be about $13,000 a month. He replaces the business owner, who the company was earning $40K a month, and the business owner was taking home $20K a month. And Fred takes $13K of the $20K that he gets, and he uses it to pay the SBA loan, which means he's taking home now $7,000 a month. As he's like, literally, the second he buys that business, he's taking home $7K a month. And he continues running the advertising agency, and then he launches his app publishing service inside the agency's customer base. So in effect, he's taken his app company and he's moved it inside the startup that he just purchased. And then he doubles revenues in 2 years. So in that particular example, Fred used an SBA loan to acquire customers, cash flow, and profits, and as a launch pad for his new enterprise that will immediately be more attractive to investors, because now he's got assets, he's got cash flow, he's running in the black. So he's going to need less money, And in addition to that, if he wanted to get money from investors in equity, or if he wanted to get finance, he's in a great place to do it because he's got a company that's in the black. Is that description that I just gave correct?
Yeah, it's a terrific example. It really emphasizes all of the benefits, and you have to compare that to starting a business from scratch. You don't have a building, you don't have a person, you have no equipment, you have no customers compared to this. This is a perfect use. And you were talking about how much Fred makes, the 7,000 that he takes home every month. That is a benefit, but that's also a requirement. Don't forget, if you're going to do an SBA loan, you have to have this as your primary business. So if it's your primary business, it has to be able to afford you. So it's required that you're going to make enough money from that business, Nancy.
Right. So the SBA won't let you make the loan unless they know for a fact that you personally are going to make a living.
That is correct. And I can tell you that there's actually a scenario we had where there was someone that made a fortune in his other business, and it was actually a problem because he was living on $350,000 from some incredible job that he had, and he was then going to buy an SBA loan where he was only going to make, there was only $60,000 or $70,000, and the SBA looked at it and said, "Wait a second. This guy's going from a salary of $350,000 to $70,000. How can that make sense for him? And could he live on that?" And it actually became a detractor because the numbers worked perfectly for that business if someone who was unemployed or didn't have such an incredibly high salary bought that business. But for him, it became a problem.
Wow.
Because you're taking a pay cut.
Right. So, and let's go on to the next example, and then we'll talk for a minute about why people would ever sell a business. Because I think that's another thing people just don't get is that people do sell businesses because they want to retire or whatever. So let's look at the next example. So SBA loan example number 2. Harriet Wilson has a custom furniture business, which is currently earning $40K a month and generating a profit of about $8K per month. She rents this is exactly the one we just talked about, really. She rents the warehouse and showroom where a business operates for $10K a month. She uses an SBA loan of $1.2 million to purchase a nicer building that's twice as big as her current space and closer to her customers. She now pays $7.7K per month for her space, but she owns it, and she generates a profit of $10K a month, and the new location is translating into more sales. So in that particular situation, she went from being a renter to an owner of the property underneath her business. And she ended up literally making it easier for her to make more money just because she took an existing business and used an SBA to acquire an asset.
And you can, when you buy it, if you are a business that could get an SBA loan, an existing business, you can move your business into a building. You could find a building across town and move your business into that building and buy that building. You don't have to buy the building your business is already sitting in. Just like the example of the kitchen and bathroom company where they took 2 separate buildings they were renting, they left both of them and abandoned both of them to consolidate into a single new building.
Perfect.
And they can also build from scratch. It doesn't even have to be an existing building. It just takes a whole lot longer to build. So I'm not recommending it.
And I just want to sort of return to the thing that we sort of talked about, that the businesses are for sale all of the time. Every one of us that's currently running a startup is in the position of we're launching a business because we're young and we're strong, reasonably speaking, and we're aggressive and we have something that we want to do. And our objective is to make a profitable business. But there's going to come a day when we're sick of that business. And then at that point, we're going to kind of want to cash out. We're going to want to get a whole chunk of cash so we can move on to doing something different, or we're going to want to retire. So we're going to get the money out of the company, and we're going to go put it in the bank and live off of it, in our golden years. So people are selling businesses all the time. So you can buy them. The SBA what the SBA does. It lets you buy those businesses. So you mentioned that, and there's a whole bunch of sites where you can find businesses listed for people that are actively trying to sell them. You can also, if you know somebody who's got a business you want to buy, you can just approach them and say, I want to buy your business. I mean, most people aren't going to get mad if you say, I want to buy your business. They're going to say, well, how much do you want to pay? And you go, well, how much do you want? And then you're having a conversation about how much it costs.
Mm-hmm.
But there's sites like BuyBizSell that list businesses by location, price, and industry. So I want you to talk for a minute. Let's say, so you do have to have like 10% down to buy a business. So if I'm buying a $1.2 million business, I'm going to have to come up with $120K. But the thing is, I'm allowed to have investors. So
that's right.
I can actually go to an investor and I can say, look, I'm getting an SBA loan. I'm going to buy this business, and I'm going to own this one. I'm going to buy it for $1.2 million. It's got property attached, and I want you to give me, the 120K, and I'm going to give you 15% ownership of the business, which will mean a couple of things. If I go out of business, the business is actually secured by this property. So you have actually 15% ownership of that property, whatever's there. So if we have to close the business down, you have some security. And the other thing is, my business is much more likely to be strong because I'm getting the SBA loan. I'm acquiring assets and resources that are likely to make my business grow quickly because I'm getting money on good terms, and I'm starting with an established business. And I think one of the things you told me, which I had never heard before, but which is incredible, which I think is it's just something that nobody has ever mentioned to me before, is that if you have an investor, if they're giving you you're giving them less than 20% ownership, they're not on the hook for the loan. So if you and I go in and we're going 50-50 and we do an SBA loan, then you and I are both on the hook for paying that loan back. You can't get out from, if the business goes out of business, and we both still owe that money because that's the way the SBA works. But if I have 85% and you have 15% ownership, then they just put me on the loan. They don't put you on the loan because you don't have 20% of the loan value. So that means that your investor can safely give you the one. You can give him 15% ownership of the business, and he can safely give you the 120K to make the loan go through.
That is correct. And you can actually have multiple investors. I think the maximum is 4 plus you, 5 in total. So you can have up to 4 separate investors.
Mm-hmm.
You can give each one up to 20%
mm-hmm.
ownership. So you can sell 10% to one, 6% to another, 15% to another. They do not have to sign now. They can sign on the loan if they wanted to, but of course they don't have to, and nobody would if
mm-hmm.
they didn't have to.
And they could give you more than the amount that you need for the loan down payment.
It's not proportional. That means that you're not dividing it. If you're giving them 15% ownership, they don't have to come up with 15% of the down payment. They could come up with 60% or 100%.
Or 120%. In other words, you can say, listen, this is such a good deal that that buying 10% of my business is going to cost you $100,000. Even though, and you could do that with 3 different people, so you end up with $300,000, even though your down payment is only going to be $100,000 on $1 million loan. In other words, you can actually have 3 investors you can literally start an SBA loan in the black, not just in the black, but with like money in your hand from investors right away. And the business itself could be actually paying you money as well. I mean, it's just normal business, because really what it is what you're doing is you're shopping for a business, and the SBA is giving you the money to make the loan, and you're not doing anything shady. This is what people do with SBA loans. This is why so many people do SBA loans. You just have to know what the hell they're doing with them, and nobody explains it.
I've seen it done actually in reverse, Nancy, mm-hmm. where somebody who really didn't have the credibility or the credit or the stick-to-itiveness, they brought an SBA loan to someone and said, this is great for you, but if you take it, I want whatever the percentage, 9%, 6% ownership. So they were given ownership, all kind of a little bit like a brokerage fee. They were given ownership. They arranged the SBA loan. They found the business, and they took a percentage that was less than 20%. So they didn't really, they took it like a brokerage fee.
Right.
But
So,
they also had no liability.
or sometimes even the owner will give you the 10%. Right. So
Right.
if I
I'm
want to buy,
I'm talking about legally. You're talking about an actual brokerage. I'm talking about somebody coming to the table and saying, "Oh, here, my friend Nancy. I think you would love this business. If you buy this business, I want 6% ownership."
right. No, but I'm
I
saying,
can have an ongoing ownership without any liability.
right. So you're saying that somebody who was very entrepreneurial, like if we had somebody on the call who's very entrepreneurial and was good at spotting businesses that would be good for people to buy, creating that matchmaking, they could actually use this to end up owning small percentages of lots of businesses and actually and generating revenue from making those kinds of matches. And
it's unlimited how many you can do because you're not on the loan. Remember the $5 million cap? It doesn't exist if you're not on the loan.
Right. So that means that you could basically do this matchmaking. If you're very entrepreneurial and you can spot a good business deal, you can basically do this kind of matchmaking and make a profit. The other thing I wanted to make sure people understood is that sometimes you find, just like with a house, you might find a business owner who's very motivated, and you can say, "Look, I'm going to buy your business, but I don't have I don't have 10%," and they'll go, "You know what? I want to get out of this business so bad. And I do happen to have the 10%. I will literally I'm going to get out of this business. I'm going to give you the 10% that you need to do the down payment. And I'm going to own 10% of the resulting business, or whatever. I'm going to give you the money so you can do this deal. So I can cash out of this business. I get because they're going to get the payment I buy somebody's business and they give me 10% of the money that they get, so that I can do the deal, right? In other words, it's just like when people take a second mortgage.
Actually, it's a little variation on that. What we do is the banks normally want 25 to 35% down. So what we often do is we often create a seller's mortgage, or we get the seller to contribute a loan of 15%. So they give 15% for, let's say, on a 2-year note. The deal. That does two things. One is it requires the buyer to only come in with 10% instead of 25%. The other is it makes the SBA more comfortable because they know that the owner of the business believes in that buyer. And we do this almost every day. I mean, this is very common practice. So the seller is showing that they're comfortable with the buyer. The seller is involved long-term, usually create a 2-year loan from the seller to the buyer.
So that's perfect. So anyway, I think we should probably move on because this is going to confuse people.
I think we're done.
Things are clean now.
Okay.
But I mean, I don't think anybody's ever explained this. So I want to talk one more, the last thing on this page, which I think is important, is that many banks say that they do SBA loans. An SBA loan, in effect, is the government, the Small Business Administration, tells a bank, you can make this loan and we will secure it. So if this guy doesn't pay back the money he's borrowed, we'll cover it. It's in effect, the SBA is insuring the loan. So a lot of banks say that you can work with them to do SBA loans, but a lot of them for all practical purposes, lie. And can you sort of talk about, I think you mentioned to me that, and again, this totally explains why I always found SBA loans, like, I didn't even think they really existed. I thought they were like unicorns. I really did. And because, for exactly this reason, when the bank has a loan, a guy sitting at a desk, and you go in and you say, I want to do an SBA loan. And he knows probably that you either own a business or you want to buy a business. And he wants to get you to open an account in his bank. So he's going to tell you anything. And he's going to also try to get you to move your mortgage there and all kinds of things because he wants you to put your stuff there. And doing an SBA loan can take 90 days. So he's going to submit your paper, he's going to say, submit the deal and so forth to the people at the bank who would have to approve doing an SBA loan, who have to do due diligence and all this extra work. And if it doesn't work out, well, that's too bad for you. They don't really care because they might have, a given bank, even a really big bank might only do in a given month, 4 or 9 of SBA loans, and they get thousands of applications. So, and they're not comparing them. They basically, whatever's the loan on top, they look through it. If it's easy to do due diligence on, they do it. And if it's not, well, screw that. They go on to the next one in the pile. Mm-hmm. And as soon as they grant those loans for that month's loans, they take the whole pile of stuff on their desk, push it into the trash can, and look at the next month's loans, because they're not going to go back to somebody 6 months later and say, oh, but the SBA loan you wanted, we're going to give it to you. It's like if you don't get given that loan in that first 90-day window, they're just going to push your option into the trash, and they're not going to let you know that they're going to do that. I had never realized that that's because they don't care. The SBA, they're not that motivated, to do SBA.
Sure. Their job is to bring you in as a client, and that's it. They don't really care about anything else. And, they call it taking it off the street. If you come in and say, I have this beautiful loan, this greatest opportunity ever, I've already put down $20,000. I'm going to work with you over the next 60, 90 days. I need to get this SBA loan done. They will say yes no matter what. They'll say yes to 100 people that walk in that door, even though they know they've only set aside enough energy, effort, money, and everything else to do 4 of them, 5 of them. And they don't care because they want that pile to be huge, because they want the clients, they want the data, and they don't want you walking across the street and doing an SBA loan with their competitor. So they take the loan off the street by saying, we'll do it.
Right.
And if you don't get the loan done, you lose a great opportunity. You lose your deposit. None of that matters to them at all. At all.
Yeah.
And that's kind of the difference between working with us and working with a bank.
Right. And actually we should move on to sort of what you guys do. I mean, this isn't really a sales pitch, for your company or anything like that. I mean, I wanted to interview you, but I want to talk about why I wanted to interview, and this is specifically why. So your company does business management and consulting services, and specifically focuses on making it so people have the right finance resources from sort of day one of they open their business all the way through 5, 10, 20 years. Is your objective is to sort of stay with the people that you support over a long period of time. A lot of the most of the things that you do for people, you're always available on a consulting basis. People can call you up and request time with a problem that they're facing and that they want to get your advice on how to handle. But you offer sort of a certain set of consulting services where, like helping people, like doing SBA loans for people where they don't pay unless unless the loan closes. That's when you refer to the fact that your limit is $1 million to $5 million. What you mean is, if somebody comes to you and say, I want to buy this business, they just basically email you, I want to buy this business. And it's for $1.3 million. You'll take a look at the business, and you'll take a look at them, and you will let them know whether or not you can get them an SBA loan. And if they say, yeah, let's go forward, then you'll go ahead and get them the SBA loan. And they're not paying anything at all until the loan is completely closed. And other than any accounting or any legal work that they have to take care of. But right.
Yes,
but in other words, you're not charging them anything in terms of the service of actually getting the SBA loan.
Absolutely not.
Getting it to the bank that's actually going to go ahead and give them an SBA loan. So
we only get paid upon success. Yes.
Right. And most of your consulting. If people buy you on an hourly basis or something like that for advice, that's one thing. But if people are asking you to help them increase their business credit or personal credit or negotiate SBA loans or something like that, services like that, you never charge anything up front.
Nope, we don't believe in it.
Right. Because the thing is, that, as you pointed out a long time ago, the issue is that otherwise people are paying for failure. Like if the people are paying upfront fees for people that are providing these kinds of services, they're literally paying for failure. They're going to pay people regardless of whether or not they succeed. And since there'll be no incentive to succeed, they're going to end up mostly paying the money and not getting anything. So the only way it actually works legitimately is if somebody says, you only have to pay me if you get the money that you promised and to the extent that you got it. So if you're negotiating SBA loan for somebody, if you basically setting it up so they get the SBA loan, the little percentage that you get is going to be based on how much of a loan they get, and it's going to be after closing, after they've got the property and all those things. It's not going to be done until the property is actually in their hands. The business that they've purchased is already in their hands.
Well, actually, when it comes to an SBA loan, we're paid at closing. So we're paid. Mm-hmm. We're actually on the loan documents, so it's all very clean and simple.
Right, and it's also and it meets the SBA requirements for how those have to be documented.
Yeah, and it's usually amortized over the length of the loan. So even though our fee is very small for this kind of loan, mm-hmm. You're going to pay it over 10 years or over 25 years.
Right. It might be like what kind of fees? Like, just out of curiosity, like what percentage?
We do actually the recommended fee from the SBA, which is 2% of the first million, mm-hmm. and 1/4% thereafter. So that equates to $20,000 for $1 million SBA loan, mm-hmm. all the way up to $30,000 for a $5 million SBA loan.
Right. Okay. So that's basically. So if you negotiate, so like the deal where you're doing the guy in the people that are doing the $5 million 2-part loan and wherever, you're going to end up netting $30K out of that whole deal.
Yeah, or a little less. Yeah, they're going to probably be close to 4 1/4 or something. Yes.
Right, and they're not going to pay it. It's literally going to come right out of the loan. It's like what the loan.
It's not out of the loan. It's added to the loan. So mm-hmm. if we ended up with a $4 million loan, it'll be a $5 million loan. It would be $5 million plus the $30,000. So right. Added on after the fact. It's after everything else is done. Right.
Okay. So what I'm going to do now is I'm going to go ahead and stop sharing the screen and put us back on. So, and then we can see if people have any questions. Because I think that we want to make sure if anybody's got some first-person questions, we might as well go ahead and get those. Okay, actually, this is a pretty interesting question. Somebody says, I bought a business, I founded a business with my brother and he wants out, and can I use an SBA loan to buy him out?
Yes, when you are buying a business, mm-hmm. you have to buy the entire business. You can't buy into part of a business. But you're now talking about 2 partners, one. That's perfectly legitimate because you're buying the whole business.
Cool.
Absolutely. In fact, the one I'm doing right now, the donut shop that I was just describing earlier, part of the proceeds of that loan is that one owner is buying out the other.
Cool. All right. This is an interesting question. So I invited film folks to this as well. Somebody said, how I don't understand how you can use SBA loans for filmmaking. Okay. I think you mentioned something about I don't know if it's relevant, but didn't you help somebody just recently purchase a post-production company?
It's still going on. Mm-hmm. They're looking for a building right now because the owner of their building won't sell. Mm-hmm. So yes, it's not for making a film, but if you wanted to buy a sound stage, buy a post-production company, buy the building you're in. Yeah, it's not for a film per se, but you want to buy into a business in the film industry. That's what it's for.
Right, but you can use that to actually make it so that you can build your production company more quickly and give it more assets initially, and thus more attractive to investors.
To investors, to filmmakers, if you're buying a rental company and a sound stage and a post-production company, I mean, my God, you half of the things you're going to spend money on, you already own.
Right. And also those will also come with customers. So you'll basically, in effect, you'll be getting the revenue that those companies would generate.
Customers, credibility, less expensive production for you. Yes, all of those.
Right. There's a question: do you do one-to-one consultations? So I think you might want to. I think you might want to address sort of the one-to-one consultations, or how people can reach you and sort of explain their situation and get your help figuring out what they're going to do.
Sure. I mean, the best way to do is to call my office or email us, and you'll speak to Asher, my assistant, and you'll set up an appointment and we'll talk. But most of the appointments are really on the phone. We don't do face-to-face very rarely. We're really, do telephone consultations because we work all over the country.
Right. And that's actually, I think it's true for most people. Let's see. So he actually mentions he's been in business for 15 years and he's out of state. So does it matter to you where people are in the United States? Do you care?
No. The last 3 film production companies that we did, which is in the last 3 weeks, we did one in Los Angeles, one in Arkansas, and God, I can't even think of, and one in Texas. So the last 3, and I only happened to meet the one in Los Angeles because I met that person in the first place at a film event. No follow-up meetings at all after that. We just spoke on the phone. So yes, there's absolutely no need to meet for this. This is debt. It's not equity. We're not partners. We're doing a banking service and consulting for you.
So when people reach out to you, do you have to provide any information, or do you just ask them questions, and then if they need to provide any information, you'll ask them for it, correct?
That's correct.
All right, cool. And you don't mind if, let's say that somebody comes to you and they're literally, just like you said, they're just somebody who's got a good idea, and they have a good idea and they know what they want to do. You can give them sort of a beginning on how to bootstrap, and then
I do, but the unsecured programs are all credit based, so they normally need some minimum level of personal credit to get started, because as we said, the unsecured programs are credit based.
Right. Unless they're thinking that they might want to do an SBA, unless they're thinking they might want to do an SBA bootstrap kind of thing. In which case,
at SBA, they're still going to need 10% down.
Right. So, but the thing is, or they can if they have that, then they can go ahead and they
have investors for it. They
can find investors for it. Okay, cool. All right. Let me see if there's any more real quick. Okay, that's cool. So I think that pretty much covers all the things that we were going to talk about. If you have any questions, feel free to email me at nancy.fulton@yahoo.com, or you can reach out to Michael Praver at mpraver@startupfundingla, and it's exactly like it sounds, startupfundingla.com. So just send an email to mpraver@startupfundingla.com, or you can go to the website and there's a link there that you can send a message if you're inclined. Cool. Anyway, thank you very much.
Thank you, Nancy.
Bye bye. Hope you have an excellent day wherever you are. You're like traveling. Bye.
Bye.
Take care, man.